So before I get underway in reviewing today's newsletter and then opening up the conversation, I do need to let everyone know that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. With that mouthful out of the way, I'm going to crack my Friday beer open and pour this lovely pumpkin nitro. It's that time of year. Get to enjoy some delicious tasting pumpkin beers. This brings me back to the days of our friend Mr. Roaring Kitty's streams, or YouTube streams, excuse me. Always enjoyed that guy, having a few beers while having some good conversations with internet friends. So while I wait for the head to settle on this nitro, we have some, good content this week. I think there was a lot going on in markets. A lot of earnings came out this week. So let me toggle this real quick. I have the wrong screen coming through. Uh-oh. Not what I wanted. Joe, help. Which setting do I need to change to get it on the right monitor?
It would be you can create it as a source. Let's see, I'm pulling it up. Or you can move your stuff to that screen.
I can't do that, unfortunately. Okay, there we go. Fixed it. Sorry about that, folks. So for those of you tuning in on Twitter, we do have the broadcast live with video on our Wook Capital Discord. If you haven't yet joined, wook.gg will get you in. Our only toll gate, if you will, is that we ask that you introduce yourself. A brief intro is all that you need to unlock access to the entire server and be able to participate and view everything. So just as a reminder for new participants and anyone who might be listening for the first time, Wook Capital Management is a private investment fund. We have this idea, this novel idea. Our CIO, John Kim, and I met through social media in 2020, working throughout the year on our GameStop investment due diligence with both each other and many other retail investors throughout the interwebs. And our experience, his experience, and both mine informed us that we believe retail investors are pretty incredible at sourcing information, and that we can kind of recreate the magic we experienced in our GameStop investment journey at scale with Wook. So we continue putting out content such as these weekly broadcasts. We had our first book club last Monday. We will be having our next book club in the beginning of December, with a firm date as well as time and book choice coming shortly. If you're a Howard Marks fan, you will enjoy the content, but I'll let John share it in the server soon on the next book club. We have no interest in ever charging a fee for any of this. Our goal is to really get a flywheel spinning where you get a lot of smart people involved in doing analysis and due diligence together, and with this idea that we can realize alpha in our investment throughout that. So, okay, enough of the Wook spiel. Let me get into this week's Wook in Review. We have some updates on tech side. We're going to talk about international investing, specifically talk a little bit about what happened in China over the last week. Markets obviously didn't like it. And we're going to, then open it up. Whoever wants to chime in once we kind of get through the prepared content is certainly welcome to. Any question or content is really welcome. market-related preferred, but it could be other. I do have a hard stop today around 5:30 or so Eastern. My parents are in town, and the only reservation I was able to get at this restaurant I've been hoping to try with them was around 6:15. So around 5:30, 5:45, we'll need to wrap. But okay, it's 4:08. So what happened this week? The highlights: mega cap tech tanks, investors disappointed. We got earnings from pretty much, we got Meta, we got Google, Amazon, Apple. This graphic is already out of date because we got a pretty broad-based rally today with a lot of risk-on sentiment, a lot of short-dated option buying, and a relatively thin order book. That's kind of been the case for a while now. Liquidity is just not there, but liquidity can cut both ways. So, we've gotten a lot of just big drops, right? Meta dropped 20 or so percent after they reported that their expenses were going to remain elevated for some time. You've got Mark Zuckerberg. Clearly, he's the one at the reins, and it's his decision. But unfortunately, the market doesn't like what he's doing presently. The stock is at 2015 levels, below $100, or right around $100, down big time from highs around 350. 70% drawdown. And it's really because, in Meta's case, just the spending. You have Reality Labs, which is their metaverse business, which doesn't generate meaningful revenue today. There's a lot of uncertainty around when or whether it will generate any revenue or meaningful revenue. And in the interim, they've committed to spending extraordinary sums on CapEx. They talked about costs for 2023 growing to a range of $96 to $101 billion. And that's not just metaverse, it's data centers, servers, infrastructure. Payrolls will stay steady. So they're not yet guiding to major headcount declines company-wide. But I think investors were disappointed to see, and here's the Bernstein analyst's quote: "We're incredibly frustrated to see expenses balloon with an almost total disregard for investor expectations." And of course, with Meta's governance structure, Zuck really has the final say. So it's pretty incredible. You've got this massive multi-hundred-billion-dollar company being led by a founder CEO who has significant control over the decision making. And at least in the short run, investors are very unhappy with his choices, and it remains to be seen what comes about from Reality Labs. It could 5-10 years from now be an incredible boon or an incredible boondoggle. I think that no one knows. We don't know the future. There's a wide range of uncertainty there. When you look at Meta's valuation, obviously with the massive CapEx spend that's kind of eating into their distributable free cash flow, they have bought back some shares, but it's more like a value stock if you just kind of look at the numbers now, although it could be a value trap, right? Are you going to see your money? So on the Amazon side of things, you've got a warning about fourth quarter, and Amazon is obviously a primary retail sales vector for both domestic and international areas. So I'm looking at, if you see my screen, consumer discretionary did end up closing green, but consumer discretionary was the only sector that was really red all day on this big rally that saw the Qs up over 3%. Consumer discretionary was up just a tenth of 1%. And I think that it's because of that warning, really, from both Amazon and Apple, that the consumers are starting to run out of there's a lot of data points out there that kind of speak to this. You've got the savings rate that has significantly fallen off to like mid 2000 levels. You have a tranche of consumers, especially the upper middle, and upper class, who have significant accumulated savings that they've been eating into, whereas folks maybe lower down on the income and wealth totem are racking up credit card debt. Credit card debt, I saw a report from Equifax today, has returned to pre-COVID levels, late 2019 levels. And I think that the trend is that will continue to rise as some consumers are going to maintain their spending and borrow to do so. And it really remains to be seen, whether we will experience a soft landing that the Fed can magically engineer, or if there will be something a little more severe. Of course, next week we'll get an update from the Fed about their next 75 basis point hike is expected by markets. So yeah, mega cap tech down big by and large. Obviously the big Apple rally today because they've yet to really see it roll over. I do think in the fourth quarter they're going to see some challenges. They kind of guided to that, but for now, investors are sticking with them. I almost feel like Apple is the last of the generals that needs to fall as this bear market continues to gnaw away at investor wealth. Matt Levin put out this massive 40,000 word crypto write-up, which I'll be quite honest, I did not get all the way through. Matt is a fantastic writer. We included an archive.ph link so that even if you don't have a Bloomberg sub, you're welcome to read it at your leisure. Could certainly be quite a bit of weekend reading. Matt is definitely not and he's open about this. He's not, a crypto. He's not like a never crypto or never blockchain. He's certainly skeptical of it, but he has a lot of experience in finance. He writes eloquently about finance, and I think he does have a good understanding of the space. He's done some good interviews, Sam Bankman-Fried, the legendary one about the box. So good read. I think that kind of lays out the crypto space a bit, and I think inherently, again, we don't know where crypto is going. Adoption, remains limited. There's obviously a variety of folks who are deeply invested in the space and feel strongly about its long-term trajectory, and there are others who feel that it's just a Ponzi, right? So while there may be truth to both of those things, yeah, this is a great write-up. I think if you want to kind of read the perspective of a more neutral, maybe skeptical party laying things out. And yeah, so we talked about autonomous vehicles, and Joe, was it the last edition? I'm losing my brain. I was in Vegas last week, and I
I
forget
think
what
it
we even talked
was
about.
the one before the last one.
It was. You're right. Okay. So in Wook Review 4, we talked about autonomous vehicles, and I think it was timely. We got a lot of news on that front this week. I think what we talked about during that presentation was this idea that level 4, level 5, like true driver out autonomy seems to have been a object in mirror appearing closer than it really was, if you will, to use that lame car joke. Ford has now gone ahead and shuttered Argo.ai, which they, with Volkswagen, were investors in. And 5 years ago, Ford made this big investment. They're now going to take a near $3 billion charge to shutter Argo. And you read some of the quotes from Jim Farley. I think it aligns with a lot of what we were saying 2 weeks ago, that these level 2, level 3, these advanced driver assist systems, there's a lot of growth opportunity for both Ford and other OEMs and suppliers to continue to build out the driver assist piece of the autonomous vehicle spectrum. But at least Ford's view is that the quote from Farley was, and I mean, it's obvious we did land a man on the moon, unless you don't believe we did, that it's more difficult to nail down autonomous driving than to land a man on the moon. So he thinks fully autonomous vehicles, profitable fully autonomous vehicles at scale, are a long way off, and that they don't necessarily have to create the technology themselves, but that development and customer enthusiasm for benefits of level 2 plus and level 3 ADAS weren't dialing up the company's near-term aspirations and commitment in those areas. So in line with that, we had noted that Intel, which had bought Mobileye, which is a purveyor of ADAS systems, they paid $15 billion in 2017 for Mobileye, and they had IPO'd to sell off a portion of the company and bring it back public this week. So Mobileye, it kind of speaks to the idea that there is a lot of value in the ADAS space. Mobileye does produce a lot of ADAS equipment. They've been around. They were founded in '99. You can kind of see from what's on my screen that the company's technology is used in more than 125 million vehicles, and that he expects the technology to be deployed in 270 million more vehicles by the end of the decade, which kind of goes back to the discussion that level 2, level 3 ADAS, there's a lot of growth that will happen over the next 5, 10 plus years in that space as level 4 plus continues to seem to be delayed. So definitely opportunity in ADAS. It seems the market obviously bid up Mobileye through the IPO. So good news for suppliers in that space. Tesla now, there's another criminal probe on their autopilot claims. Of course, autopilot is an ADAS system, despite some user misunderstanding of it. It's a hands-on level 2 system, hands-on, eyes on the road system. But DOJ now has this investigation that Reuters reported earlier this week, scrutinizing how the system was marketed and the claims about autopilot's capabilities, quote, imbue customers with a false sense of security, inducing them to treat Teslas as truly driverless cars and become complacent behind the wheel with potentially deadly consequences. Obviously, there's plenty of Elon Musk tweets about the million robo-taxis that didn't come to be, the tweet from 2016 about, you can drive cross country with your robo-taxi or summon it cross country in 2 years. So of course, it all kind of goes in line with that. This stuff does appear to be further out on the fully automated side, and that those who are maybe overhyping what they have perhaps are starting to face some pushback from regulators on that front. But remains to be seen. Perhaps there'll be a solve for level 4 sooner than we think. Google Waymo just the other week talked about expanding their offering into San Francisco. We know they had the offering in Arizona, and I think it was LA. Obviously, Cruise on the General Motors side. Similarly, Cruise, GM is bought back from SoftBank earlier this year, the portion they had sold off. So look, just seems like the trend, broadly speaking, is ADAS, big growth vector. It's going to be there for a long time. But level 4, Ford is thrown in the towel at least, and we'll see what happens. Again, once we get through the prepared content, if anyone wants to chime in on this or any of the other items we're talking about, please do so. So yesterday, we finally got closure for the whole Elon Musk Twitter saga. He is now going to take the reins as interim CEO, and he fired Parag and some others. So for now, my Twitter account hasn't been shut down, thankfully. It remains to be seen what he can do to cut cost and improve the profitability of the business. Of course, he took on a lot of debt. The banks are going to eat hundreds of millions in providing the services of that debt. They're going to hold it down in their books, I think, for some time, since bond markets have deteriorated, and overall the market's deteriorated since this spring when Elon first got this wild hair. But the deal has been consummated. Folks who bet that it would be were paid off handsomely. So now we'll see what comes next from Twitter. Okay, 422. Again, we're going to run till about 5:30 today, 5:45. I'm going to run through this fairly quickly. Look, there's a lot of literature out there. I don't want to inundate you with all of this. Some of you might not care about China and international investing, but I'll try to present some of the information from a neutral perspective. We included Mr. West's famous line from one of his good albums back in the day when he was taking his medicine: "No one man should have all that power." I think Xi Jinping arguably has the most power of any man in the world, man or woman. He has really solidified control over the Chinese Communist Party. And we included, as I said, a lot of links here, kind of talking about what happened at the 20th National Congress, just to maybe kind of go over some visuals. This one was a good one, just kind of like showing, what these are held every 5 years. And, Xi effectively has made it so that he may end up being president for life. He is not adhering to the traditional or the historical norms. He now has secured a third term. and obviously there's no indication he won't be staying on for a fourth or longer. Um, he has really appointed a lot of yes men, I guess, if you will. Kind of Xi allies dominate is the line here. Um, again, I think that what it means is that Xi is playing a very long game. He's talking about this view that in 2049 that China, quote, to lead the world in terms of composite national strength and international influence. So that is seemingly an increase in tension and competition with Washington and others. Uh, they've kind of alluded to accelerating the recapture or the reclamation of Taiwan. It doesn't mean that it's happening overnight or next year, but it does appear that the Chinese are steadfast in regaining what they view as a breakaway province. Of course, that is as a byproduct of the communists winning the Civil War in 1949. So she has a lot of power, and investors really didn't like it. So on Monday, markets closed down big time. Chinese ADRs listed in Hong Kong. I thought I had the graphic here. Pull up another. All right, did I include it in the newsletter itself? Sorry. The kind of relative valuation of the Hang Seng China Enterprises Index to the S&P 500 is really at its lowest level since .com era. The Golden Dragon, another index of Chinese tech, like if you just look across the spectrum, completely gutted. If you're a Alibaba bag holder, you're near all-time low levels since the company IPO'd. And I think really what it gets back to is investors are very uncertain. Foreign investors are very uncertain after having seen what happened with Evergrande earlier in the year. Making payments, say, to yuan-denominated debtors or creditors ahead of international creditors. I think in a nutshell, it seems obvious that the markets view China as much less attractive, with much more political risk for international investors than it did prior to this 20th National Congress. There's obviously the domestic Chinese economy that's dealing with the continuation of zero COVID, which is hampering growth in the domestic Chinese economy. I don't have the graphic on screen, but there was a good graphic I saw recently showing the massive decline in data points that the Chinese Communist Party publishes. So economic data points are just going dark. There was the GDP release delay that didn't come in a timely manner. So broadly, you're getting less and less clarity, less certainty that you as an international investor will have your rights, the rights that you may expect in the United States, respected by the CCP, and therefore capital is fleeing China. International capital is fleeing China. There's some conversation that we included in the write-up about what's going on with the Chinese domestic property market. There was obviously this massive debt binge that built up over many years that is starting to maybe get paid, right? Like if you're a Chinese national living in China, there's only so many places you could put your capital, and the place had been housing for some time, but you've got this commitment that Xi is kind of noting that housing is for living, not for speculation. So the housing sector has been challenged by these overblown debt balances that are getting some of them are failing. China is kind of just a mess on the housing side. I would love it if anyone who has expertise into China would want to chime in on that front. But Societe Generale, SocGen, economists noting that immediate exit from zero COVID has become less likely. A small recovery in the housing sector could occur. Another VP at IFAS Global Markets noted the market situation currently might be the worst I've seen in my career. Sentiment is even worse than the 2008 global financial crisis. So, sentiment's bad. The underlying economy is not doing so hot due to the constraints of zero COVID and the massive debt and housing overbuilds, fueled by some speculators. So there's a lot of uncertainty with China, and it's become a less attractive place, as investors should expect the state to relentlessly increase its weight in the Chinese economy growing forward. So to kind of wrap up the prepared conversation from the newsletter, I included some data points around international investing. One of the thesis behind, again, Wook, is that we believe that through active stock picking and investment management that we can outperform our passive peers, which most active funds and investors have underperformed for many years now. The S&P 500 is kind of your de facto benchmark for most domestic investors. I thought it is very interesting that in China's case, per Morningstar, 76% of active diversified stock-heavy funds survived and outperformed their average passive peers during the trailing 10 years through the end of December 2020. Now, that's a little bit of a stale data point, so I don't know if that's changed materially. I don't imagine it would change that much. But for 3/4 of actives to outperform passives, that's just night and day from both the US and most of the rest of the world. I'm going to pull up S&P Global has SPIVA. This is I'm going to flash some different graphics. You can see stateside, almost 90% of funds over the last 15 years. Let me go to 10 years to make it one for one. It's over 90% of the active funds underperformed the S&P 500. You look at Canada, it's a little lower. It's still over 80%. Mexico, a little bit lower still. The theme that I've seen from the data that I've reviewed over the years is that the less developed you get, the more of an opportunity there is for active management to realize alpha in stock picking. The Chinese data point is a little bit of an outlier on the high end for active managers, but you see, for example, India kind of taking it further still. You go US, Canada, Mexico, India. You get less underperformance for active managers over the last 10 years. Obviously, the last 10 years is just one time period, but the SPIVA data has kind of been going on for only 15. We don't have a ton of super old historical data, and of course, active versus passive. Passive hasn't exactly been around for all that long. Thank you, Mr. Jack Bogle. But it's interesting because I think a lot of folks have the view that active stock picking going forward should be more attractive in this shift away from a QE regime that has fueled a lot of multiple expansion and price expansion over the last decade or so since the Great Financial Crisis. I'd love to hear some folks' thoughts on that. Just flashing Japan again is another one, more developed country, and the active management more in line with the US, 86% underperforming. So I think that's very interesting that China, you have that active management outperformance. But obviously China, there's what we just talked about with the Chinese Communist Party led by Mr. Xi. There's, of course, been those crazy small cap IPOs in China that led to some wild implied market caps, that this freeze of Chinese small caps coming on the back of, what is it, AMTD Digital, that it was for a brief point in the beginning of August, one of the most valuable companies in the world, which made no sense. And obviously that dislocation eventually resolved itself, but I think understandably so. You have concerns from various both regulators and market participants about this not being a good thing for markets when you see this kind of a pump and dump scheme or market manipulation. So you've gotten kind of a pause button pushed, a variety of incremental requests for information from NASDAQ. So yeah, you got that on the small cap Chinese stock front. You've got the deal that was realized 2 months back between the Public Company Accounting Oversight Board, PCAOB, mouthful, but that is kind of the accounting board that is with SEC working to resolve the fact that these Chinese entities have historically not submitted to American-based audit. So the deal, it's still uncertain, right, whether the agreement can withstand political pressures from the Chinese side and from the American side. The agreement is that under SOX, under Sarbanes-Oxley, there's certain requirements of auditors, and in this case, these audit work papers that the Chinese have and Hong Kong-based firms, for U.S. listed Chinese firms, have not necessarily allowed outside auditors to review. So, will this go forward? Will these companies be delisted? Obviously, there was the Luckin Coffee fraud that led to the Senate passing this Holding Foreign Companies Accountable Act that threatened to expel Chinese firms from U.S. exchanges unless PCAOB were permitted by Beijing to inspect the audit papers. So that was a bill signed by former President Trump in the end of 2020. Between then and now, there's been some goings back and forth to have this deal. It would be great, I think, for investors if you could really get a resolution here for domestic and other investors outside China who wish to invest in the U.S. listed Chinese companies. But again, it's an uncertainty. It's a risk factor. When you have uncertainty and risk, you demand a higher premium. You're going to have a higher discount rate, which all else equal means you're going to need to be willing to pay a lower price for the securities to find a reasonable return. So, yeah, interesting stuff going on. And then lastly, I had included this report from BlackRock that was showing, look, a lot of folks are calling for low forward returns from the U.S. side. The U.S. has outperformed international stocks. A lot of international stocks are at extremely low levels relative to S&P beyond just China that I flagged earlier. Obviously, international, depending on where you're talking about in the world, has a lot of its own risks, whether it be currency. Obviously, in Europe, you have the energy risks and other political risks. If you're invested in, say, an industrial firm or manufacturing firm. But the findings from BlackRock in this case were that international stocks historically outperformed in periods of lower U.S. stock returns. So given that due to high starting valuations, although obviously multiples have compressed meaningfully over the last 12 months, the attractiveness relatively of international versus U.S. When U.S. returns are low, international over the last 40 years has outperformed always when it was less than 4%, almost always when U.S. returns were under 6%. In all return periods, the U.S. outperformed a majority of the time. But if you have a view that U.S. returns are unattractive, international might be interesting, but there's a lot of risks you need to consider there. So wanted to include that and see what kind of conversation we can have about international stock, about what you think about when you're making an investment decision into a foreign market or a foreign company. I can share some personal on this is unrelated to Wook, but on me personally, I have investments in British American Tobacco, and I own the U.S. listed BTI, and it's really lagged because of how much the U.S. dollar has appreciated versus the pound. So that's a currency risk that I took on that was unrelated to the underlying business, but it was certainly a factor. So, okay, 4:37. We got through the prepared content in about half an hour. I think we have about an hour for whatever, if we want to dive deeper into any of the stories or any of the other matters. I know, Jimmy, you requested to come up as a speaker. Anyone who is in the Wook Discord is welcome to submit questions via the voice chat. And yeah, let's get to it, Joe, and or Jimmy. Who wants to interrupt the lovely monotony of my voice?
Well, Joe is the co-host, so I think he should have the first word, but I've got some comments and
Go
some
ahead,
questions.
Jimmy.
So, okay. Thanks for hosting this again. I'm driving, so I want to make sure you can hear me okay. Hopefully my voice doesn't come in and out. So a couple things, Mobileye I thought was very interesting. We're in the middle of this, what I consider a bear market rally. And so for the stock to pop the way it did, I know it was a pretty low float issue. But it was interesting, if you had waited a week or two earlier, I don't think it would have had the same reception. And it kind of reminds me of the Rivian IPO, where they really jammed all these institutional shareholders in who really wanted to get an allocation. But I've been active in the autonomy lidar space, and so the fundamental due diligence on Mobileye is a little concerning. So this is a company that is now valued at about $23 billion. They have about $770 million in cash. So for revenues, they have a 47% gross margin on their software autonomy product, which is not great. It's not 80%. It's not a SaaS business. In fact, I would expect those margins to compress over time as you get more competitive dynamics, or as some of the competitive dynamics shake out. The big backstory with Mobileye is that a lot earlier in the cycle, a lot of these automakers got burned, right? Because they were involved in the hardware, but they were giving out high gross margin part of their business to this company, Mobileye, which is also owned by Intel, right? It finally got spun out. Intel's still a big owner. But when I think about the future of automation, of ADAS, you got a lot of big players with a lot of capital, and there are going to be a couple of different points of pain and leverage where people are going to squeeze each other out, right? Who's making the hardware? Who's making the software? Who's creating the communication platform? And then if you're going to make it in the millions, what are the auto tier ones and OEMs going to say? So, frankly, looking at the way that growth companies have gone, the companies at 47% gross margin, they spend about 40+% of their revenue on R&D. So they don't have positive cash flow, or they're at a break even. When it's all said and done, this could take a 75% haircut. And that's not a stock call, but it's when I see the similar sets between other growth companies and other LiDAR companies, it's pretty clear to me that it's a hot issue right now, but I probably wouldn't allocate it for my clients. And then I thought, secondly, on the Chinese market, that was quite interesting. If you guys recall, like many, many years ago, when Mike Pence was vice president, he spoke at the Hudson Institute, and that was widely held as one of those seminal pivots in U.S.-Chinese foreign relations, where he really detailed a lot of the longer-term geopolitical threats and strategic dynamics, and he laid it out in a very hawkish way that I think previous administrations have not realized. And so when I look at Xi Jinping, the whole thing with Hu Jintao and just the way he's taking control of the economy and of the party, he didn't graduate from business school. He's not a capitalist in that sense. But for me, this is a great excuse for institutions who have been underperforming to basically blow out of China. They're getting the tap on the shoulder by their risk managers, their compliance managers. And, I think we saw on the day that everything was down 15 to 20% is really that institutional blowout. Now, if I'm a trader, which I am in some accounts, there might be a couple of spots to go bottom picking. But frankly, I think China is in for some tough times ahead, especially on the capital markets front. Some say ultimately they're going to have to pivot away from COVID zero, not because they want to, but because they have to. But I think it's dead money in the near term, and the volatility profile is pretty, enormous to say the least. So it's good luck trading to all those who are involved.
Well, Jimmy, thank you very much for chiming in and sharing your thoughts on both. One thing I always try to not get hyper. I'm a strategy guy. I obviously look at the big picture. And when I think about what you were talking about on the automotive side, something I observed over the last 5 or so years is a lot of the legacy OEMs appreciate and understand that whereas historically they might have wanted to do it themselves, and you've seen it, across the spectrum, whether it's the think about a collaboration between Mercedes-Benz and BMW. You never would have expected that if you think back, 10 years, even 5+ years, and they were working together on a variety of mobility solutions. General Motors and Honda working together on electrified products, as well as autonomous products. There's a lot of collaboration because there's so much damn capital that is getting spent and will continue to get spent in all of these future mobility investments, be it EV, AV, shared services, all of that. And McKinsey calls them the ACEs trends. But Tesla is kind of in a league of its own in standing alone and not working collaboratively with anyone. So it is very interesting to watch. I think you will continue to see, and I think we talked about it a couple of weeks ago, this continuing trend of OEs trying to work together. We talked about the ICE business of Volvo, desiring to work with others on the powertrain side, on the legacy powertrain side, right? Because they know they're going to have to continue to make these products for many years, decades. Even if you believe the Europeans that they will fully ban it and the Californians will fully ban ICE by 2035, which I do not believe. That means that for the next 12 years minimum, you need to continue to iterate, improve. And when you're kind of shifting your investment focus to these future technologies, it's a hell of a lot easier if you can collaborate with, your competitors, in a sense, on this legacy side, lower cost, spread out the cost across multiple companies. Obviously, you have these different automotive alliances that have come in and out of favor over the years. But I think that trend continues, especially when we look backward at ICE technology. Companies don't want to. They have to continue to support it, and they have to continue to iterate and improve upon it. But obviously, the spot they're looking to make more of their bigger bets, of course, is the future growth in EV. And I think it's not purely related to the Mobileye discussion, but I just wanted to kind of add that. I think that's what I'm seeing. If anyone's seeing differently or disagrees with that take, please chime in. But yeah, the automotive space is tough, right? It goes back to that conversation about Warren Buffett saying, you could have known, you could say, yeah, we know automobiles are going to be the next big thing. And of all of the hundreds of companies of auto OEMs, only one didn't go bankrupt, and that one didn't even go public until the 1950s, Ford, right? So you could have a view of where the future is going to go. It doesn't mean that it's a slam dunk to invest in that sector. And I do think automotive continues to be a very high risk sector. It's very capital intensive. It's
and I think for all those reasons, when you're in such a competitive industry with pretty low margins and high capex and regulatory requirements and safety requirements, like giving away a small but maybe meaningful portion of that business to another provider at a high margin is like an existential threat. It's like a no-no, and you want to bring that in-house, which is interesting, right? Because right now you've got the collaborative dynamics, but you have the competitive dynamics. Like NVIDIA wants to make its own software. They already do. Qualcomm, same thing. So if it's not Intel, if it's not NVIDIA, if it's not Qualcomm, there's going to be battlegrounds for hardware, for software. I don't think it's a winner-take-all market, but especially when it comes to, I think NVIDIA at their, GTC conference, they talked about NVIDIA Drive, where because of machine learning and AI technology, they can basically simulate thousands and thousands of hours of driving time. And there is, especially when you're getting kind of big data, there is that winner-take-all mechanism. But it's going to be very
audio's jumping in and out a little bit, Jimmy. For sure. It is impossible to ignore. It's fascinating. That's why a lot of eyeballs are on it. There's a lot of money that continues to go into it. I still, and I think people have heard my view that a lot of the startups, many of the startups, the EV players, suppliers, etc., especially as capital markets have become far less willing to fund long-dated, uncertain future cash flows, I think that there will be a lot of dot-com-esque nature to the implosion of that space over the coming years. But that doesn't mean that EVs won't proliferate. It simply means that maybe it's not an attractive place to invest your capital, or maybe you need to look at different aspects of the value chain. Like I know There's the recycling angle. There's the battery materials themselves, right? If you want to look at miners, although historically, of course, if you're in a commodity business, it's just race to the bottom. But just thinking that maybe there are other places in the automotive value chain to look rather than just the OE or a T1. But good discussion for sure. AV, EV, I always love talking about it. I don't want to make it the only thing we talk about, of course. But Joe, what do you want to talk about?
Yeah, I was actually gonna chime in about the Musk news. I know we've been following this in the Wook in Review quite a bit. It made its way into the highlights today, and today we found out that Elon Musk is forming a content moderation team. So, Musk said he was going to be lifting lifetime bans, but it looks like the way they're going about that is they're going to try and hire a diverse group of people that'll review bans and the content on the website and make sure that people are looking at this from all different angles. So I think that's a good step. I think it's we're going to actually see things happen. We can't call it a victory yet for free speech or anything like that. But if he can actually put together a team of people with different backgrounds and different opinions on things, that sure beats what I'm sure San Francisco's used to, which is obviously largely left.
Yeah, let's see what he does, right? He's obviously been wildly successful with many of the businesses that he's either been involved with or stepped into. Twitter, as he's kind of said, it's the public square. It's a very popular venue. I know I say it all the time. It's one of my favorite social media platforms. You get to interface with some of the smartest people that exist worldwide, and you can just ask them questions in in an open format. And I think it's fantastic. Obviously, remains to be seen what his fixes are for the bots that he's been so upset about. Like you said, with this content moderation council, what does that exactly mean? Yeah, let the good times roll.
Yeah, I mean, he's going
Mr.
to be
Musk said.
CEO while also being CEO of SpaceX and Twitter. And Tesla. So he's going to have his hands tied. He's going to have to really surround himself with great people that can help him make these decisions and fill him in on the daily tasks. I know he brought in Tesla engineers to Twitter to take a look at the code and tell Elon what they think and what needs to change. So we don't know if widespread firings have taken part yet. I know there was a few software engineers that were let go, but
yeah, and there was also, you may have seen the I guess crisis actors. There was one whose name was
yeah.
Ligma. So the reporters didn't do a great job vetting these fake Twitter firees. But you just have crazy shit with everything that relates to Elon Musk. You can't help it. Free media for some people, right?
Yeah, I give props to the guys that pulled that off. That's pretty funny. It's definitely taking advantage of a vulnerable media that'll take anything Musk related and run with it.
For sure. And of course, the former president made a comment about the African American owned business, since Mr. Musk is, of course, born in South Africa. So we'll see how long until Mr. Trump is back on Twitter. But that said, okay, we talked to Elon, we talked AV, we talked China. I made the comment about international investing, and I'd love for people to consider chiming in. I find international investing is really hard personally, and I know that while Wook considers the whole world of public equities as our oyster, broadly we are focused on U.S. equities. I do think it's hard for international folks in some markets to really have any sort of edge or unique insight. I, in the prepared kind of commentary, was talking about how the data from S&P show that active managers in less developed markets do better than their most developed market peers. And perhaps the answer is simply to look at, when you're looking at international markets, maybe that's where you opt to index, or maybe that's where you opt to find a manager you have a lot of comfort in, who's got credibility, that you know, deemed to be a good one. I'm thinking about Mr. Templeton, right? No, Mobius, Mark Mobius, right? Mobius. I'm thinking of Morbius the movie now. But he's a famous emerging markets fund manager, and maybe that's the play for international. If you don't have any inside knowledge or exceptional competency in an emerging market, then find a Mark Mobius to line up behind and invest in his fund, right? I'm not encouraging that in this case. I'm just using him as an example. But I'd love to hear some folks' thoughts. I'm sure we have some people who are not U.S. based, and I'd love to hear how they think about international investing and the different puts and takes. And maybe for them, international investing is the U.S., and maybe they focus on the U.S. And as we noted, the U.S. has had some incredible returns relative to the rest of the world over the last 10, 15, 20 years. But does that mean that forward returns in the U.S. will exceed international? That's of course the magic $1 trillion question. But I would love for other folks to chime in. And if you're shy, you're welcome to submit a question on either Twitter, or if you're in the Wook Capital server, in the voice chat, where I am hosting the video broadcast live. And Joe will, of course, post this to our YouTube channel after we wrap. But I'm hoping that we can keep this conversation going for another 30 minutes or so. International investing, how do you think about it? Not all at once.
Rod, what would you consider Amy? So it's international, it's Canadian. Do you think of it as an international investment, even though it's not too far, and it's really markets aren't too different from what we're used to?
So with international, when I think about Canada, it's obviously a developed market. There's a good respect for the rule of law. There is some currency risk with USD to CAD, but it's not the most volatile, I think, of currency relationships. Yeah, of course it's international. A Canadian company, for me as an American investor, is international, and I think inherently I'm taking on some incremental risk, all else equal, right? If it's a large cap US company versus a large cap international company, I tend to personally view that on the risk spectrum as marginally higher risk. Therefore, I should demand as a rational investor a higher reward. Yeah, again, as I said, whether it's American Manganese, which is now Recyclico, or British American Tobacco is my second largest position, and that's one that it's a UK. It reports in Great Britain GBP in pounds, but most of its profit is actually generated in the US, so it's a little bit different, right? And you could of course have US listed companies who generate a big portion or even the majority of their profit or revenue in international markets. So just because a company is listed in one place, right, that doesn't necessarily mean it fits into that category. But I think there's a lot to think about. You obviously need to consider politics, geopolitics. You need to consider currency risk. You need to consider, if it's a country that has a lot of inflation, right? If it's a country that doesn't necessarily respect the rule of law, and you have to worry about, maybe, look, a lot of people piled into Russia in the first quarter. as Russia was kind of on the cusp of invading Ukraine. And maybe when the dust fully settles and maybe Russia eventually returns to the global marketplace in a different way. People who piled into Gazprom and Yandex and these other Russian equities will be able to realize a return. But there was a huge risk when the invasion occurred, and obviously now I think that a lot of those securities are illiquid and you cannot trade them. So yeah, I think there's just a lot of different risks. All else equal, for the same type of security, an international one, I think, demands a higher, it's higher risk in my view, and therefore you would expect a higher rate of return. But again, look, I don't want to just keep saying my spiel. I'd love to hear what other folks think about international investing. But yes, Joe, to your question specifically, yeah, Canadian companies, yes, they're international, but kind of like that little part of the prepared remark, I think of Canada pretty close to the U.S. Obviously, Canadians are not American citizens, and vice versa. I love visiting Canada; it's a great country. Always enjoy my time there. But I think that the norms, right? Obviously, but for Quebec, it's mostly English speaking. They're going to be more like the U.S. than, say, if I'm making an investment in a small frontier market in Africa. Or in some, again, frontier market in maybe Southeast Asia. That's where there may be great opportunity, and I think there is great opportunity, but how do you get that insight? How do you get that boots on the ground knowledge? I think back, to the discussion we were having in the book club. We didn't really get to focus on that chapter actually, and I think about the conversation we had. But there was one investor, and her name is eluding me right now, and Richer, Wiser, Happier, and she was living abroad, living in these countries, really understanding how those countries work, how their markets work, the different kind of idiosyncratic considerations that you might need to have in an international market that might be unique to it, right? So, like, I think if you're going to have an edge in international, you need to make sure you know what it is. Otherwise, again, I think you need to find some. Obviously, past performance, right, is not indicative of future results, but find competent fund managers, or well, the easiest thing, of course, is always to just pick the index, find a low fee that covers the geographies that you're looking to invest in. But yeah, would love to hear other thoughts from folks. And if not, that's fine. We'll keep it going. One thing then, and assuming no one's going to put their hand up, I had seen in Bloomberg's Hyperdrive newsletter, which is a good information source, I think, to kind of stay abreast of what's going on in the mobility space, but was kind of talking about, thinking again about international risk and considerations. It talked about for the German car makers, your Volkswagen, Mercedes-Benz, BMW, and of course the French with Peugeot and Citroën. I might be butchering the pronunciation, sorry. The Germans invested heavily in China, right? Especially Volkswagen. Volkswagen has something like 40 production facilities across China, for over 40 vehicle and component factories, along with partners in China. So I thought it was just very interesting because it kind of talks about how Stellantis, formerly Fiat Chrysler, is talking about being ready to cease making cars in China. They also make Peugeot and Citroën, and they implement an asset-light strategy for those brands. When he talked about withdrawing from the company's Jeep-making venture. So if you're VW, you've invested a hell of a lot in China over the last couple of decades, and you're pot committed, if you want to take a term out of poker parlance. Whereas Stellantis didn't have all that much in China, right? So it was easier for them to decide, maybe we don't want to play Xi's games anymore. And the newsletter cites BMW shifting production of the electric minis from China to, BMW shifted production of electric minis to China from the UK and is assembling an SUV model there. Mercedes, right, makes its Maybachs to Chinese consumers, and then kind of a Berlin-based auto analyst noting that the Germans can't bite the hand of the one that feeds them. Whereas for Mr. Tavares at Stellantis, it's a different story. And he is likely saying what a lot of other automotive executives are thinking, unquote. So, if you're a General Motors, not that GM is mentioned in this, but GM has a major presence and exposure to China. You may almost be feeling like, well, damn, I went into this market years ago because it was a huge growth opportunity. It has become the largest automotive market on the planet, but now I'm seeing all of what's going on with Xi and with, can I get capital out of China? Are there other risks maybe I didn't think about? And yeah, I just think it broadly dovetails with the conversation we were having. So I recommend it's a free newsletter. Bloomberg's Hyperdrive, I think, often has some good writing in it, but it kind of dovetails with what we were talking about. Joe, what else? Give me another headline.
Yeah, I'm thinking of some hot news this week that we haven't yet talked about. We've kind of covered a bit of everything. I really like how we have the highlights section now, so we actually get to speak on more than just one topic. But I think
real quick, I'm gonna cut you off for a second.
Go ahead.
Quick. Today is the last day. If you haven't yet funded your I-bond, if you can get the Treasury Direct website to work, which I've literally been trying for multiple days to buy my girlfriend an I-bond. We obviously had this conversation a couple times, but the I-bond rate will drop from 9.62, whatever it is, for the next 6 months. If you buy it by midnight tonight, I think it's Eastern time, you get that rate for 6 months. Otherwise, it goes down to 6.4 something. So nonetheless, the federal government is not exactly on technology's leading edge. So if you're watching my screen, you can see me trying to navigate Treasury Direct, and it's just been a complete cluster for the last couple of days. It just times out. You get halfway through, it kicks you out. So there was a Wall Street Journal story I saw, I think this morning, talking about how the U.S. government sold, was it $500 million in the last day or so of these. There's been many accounts have been created, but unfortunately, I haven't been able to create one for her to try and get across the finish line here.
Yeah, it won't load because Jake's over there creating 100 LLCs to put a few $1 million in I-bonds. He's overloading the servers.
Too funny. I wish he were here to respond to that. but look, like, again, I know I've said it before, but if you have cash, somebody in the GME server was saying, what should I do? I have this money for a down payment I'm thinking about, and then, like, obviously we're not advising him formally, but I think about something like there was an Ally Bank savings. Sorry, I'm trying to type in and talk and think at the same time, and my brain isn't that good. But like Capital One now, for example, the Ally Bank was offering this. Capital One is offering this, where if you sign up for an online savings account with them and deposit, say, $10,000, you'll get a $100 bonus. 50,000, you'll get a $500 bonus. You need to maintain the balance for 90 days. But if you think about the rate during that period, you're going to get the typical deposit rate plus the bonus rate. And for an FDIC insured deposit account, obviously up to whatever the bonus constraints are. In this case, you can deposit 100,000 and get a $1,000 bonus. So, assume you need to maintain the balance for 90 days. Let's say there's some lag on the front and back end. Maybe it's really more like 120 days. You're going to get the 2.25% APY on the account plus the 3% APY from the bonus. So, for 3-4 months, you're going to get a 5.25% risk-free out of Capital One in that particular example. And I think there will continue to be more of these. Obviously, the Fed is going to raise rates next week. I'll pull up the CME's FedWatch tool, which can tell us what is currently priced in by markets. So currently, it looks like, what is that, 75 basis points priced in. There's an 82% probability of 75 and an 18% of 50 on November 2nd Fed meeting. So rates, right, short-term rates being driven by the Fed funds rate will continue to rise unless something jarring happens and the Fed changes course. But there's you can get yield in cash now. So obviously related to the I-bond conversation, there's some opportunities in just basic demand deposit and savings accounts, depending on sign-up bonuses, to get some yield. And if you're trying to save a down payment and keep that money liquid, at least fend off inflation. Maybe you're not beating it, but at least you're not losing quite as much to it. So just some thinking there on what to do with your cash. And I have to say, if you like pumpkin and if you like coffee, this pumpkin cold brew nitro is fantastic. So just tried it for the first time last night, and I'm enjoying this right now. It is delightful. Shameless plug for random beer.
Rod, what's your thoughts on Meta as it stands right now? Is it still under 100? I haven't looked. Meta. It's 99.20. So it's up 1%.
I missed the first thing you said there, Joe. What about Meta?
What do you think? Is it going to keep falling next week? Do you think it's attractive at this price? Because you had been expressed some interest in it.
Yeah, I think I made a comment on Twitter on my account. Let me pull it up. But the thing that happens with a situation like this is that the people who were invested in Meta heading into 2022, that investor base is having to turn over, right? Not everyone 100%, but largely folks who were invested in Meta are growth investors, I think, expecting revenue to continue to grow, expecting gross profit, it flowing all the way through the income statement down to free cash flow. Really, again, the metric, like if you're thinking of one metric to rule them all, Lord of the Rings style, free cash flow per share. And Meta is burning, that free cash flow on this idea that Mark Zuckerberg has that is very uncertain. So you have now the company shifting from growth to not growing anymore because family of apps, is facing headwinds from advertisers pulling back, from TikTok. So if I'm a growth investor, maybe I've already sold Meta. I either took a gain if I was a long-term investor, or I ate a loss if maybe I jumped in recently. And then if I'm a value investor and I'm thinking that I'm buying these cash flows for cheap at a discount to the intrinsic value, well, there's so much uncertainty around what the fuck, Zuck, right? Like where, yes, they're doing some buybacks. It's relatively minimal in the scheme of things relative to how much they're spending on CapEx. So it's like he's scared off the growth investors, many of them. Some of the value investors, maybe they're interested, maybe they already tried to catch the falling knife, gotten burned. So, I think you're in a situation where it's probably going to be deadish for the near term, barring a big shift from Zuckerberg. The analysts are unhappy about his commitment to keep spending all this money with no clarity on what the payback looks like for all that investment. Look, it's on my screen at 99.20, and you have to go all the way back to early 2016, the last time it was under 100. And look, it looks like a value stock now. PE ratio 9. A single digit PE is not a growth stock, but again, value investors may not be interested in touching it because of all that uncertainty. So who knows? It's Zuckerberg's show, and if you're invested, you are very clearly along for the ride with Mark. You don't, there was some altimeter. Let me pull it up. They wrote a letter to Meta. Meta must stop overspending and cut jobs. Meta shareholder writes an open letter. I'll be honest, I didn't read the letter yet. I heard about it. But pardon my crude language, Zuck don't give a fuck. Zuck don't care about your 0.1% ownership. Mark Zuckerberg is going to do what he wants to do. And whether eventually enough investors say to him, Mark, we're bailing, he's not reliant on capital markets, right? The company is generating cash that he's burning by virtue of investing with an uncertain return. It's his show. So it could end up being one of those incredible investment opportunities if Metaverse takes off and they take meaningful share and they become competitively advantaged because of their hardware software integration, a la Apple, in kind of current tech on the at least cell phone side and all the related things. So he has a vision. I haven't listened extensively to Mark's interviews on the matter. I know he had one with Lex Friedman months back. But that's really what it comes down to is, do you believe in Mark Zuckerberg? And even if you do, you have to acknowledge there's inherently uncertainty about whether he can accomplish what he believes he can accomplish. So, I would say if you're trying to buy Meta right now, appreciate, as with all falling knives, that it could continue to drop. If you bought Meta after it dropped from 336 on the last day of last year, and if you bought it at 200 in March, you're already down 50%, even though you had just bought it after a 40-ish% drop. So cheap can get cheaper, and in this case, what looks cheap can begin to look expensive if revenues decline, margins decline, spending rises as they've guided to. So, Facebook, to me, it's not just looking like a potential value trap. It's, if family of apps keeps losing share to TikTok and losing advertiser dollars, and we have a steep recessionary environment, advertising tends to be a thing that gets hit, right? We saw even Google isn't immune to that. Who knows how low Meta could go? But on the other hand, very high upside potentially. So I will say, in my personal account, I bought some shares and wrote a $100 put that I then wrote a call on the 100 shares that I bought. So I'm kind of playing it as I think technically it's very oversold, and most of the people who are bailing have gotten out by now. And I think that with the volatility pretty elevated, I can at least, in my tax advantaged account, generate some income trading around this position. But that's not me buying into Mark Zuckerberg as a long-term buy and hold right now. So just some of my thoughts on the matter. I'd love to hear from other folks what they're thinking about Facebook. I mean, you get a very visceral response from some people. They have very strong negative feelings about Mark and or Facebook. Obviously, the company is not just the blue app. So I would love it if anybody wanted to chime in. Joe, maybe if you had thoughts you wanted to share.
Yeah, I was going to say, I think a lot of people invested in this vision of Facebook. I mean, it wasn't too long ago. This was trading under a totally different ticker.
Yep.
I think when he rebranded it to Meta, changed the parent organization to Meta Platforms, it was very clear that an investment in Facebook now was an investment in this vision of the metaverse, which is a huge gamble. And considering the market is nothing like what it was last year, and no one is really as confident in the metaverse as 12 months ago, it's a gamble that hasn't paid off. I think if this was still trading under Facebook and it was still, the focus was Facebook and building out Instagram and building out Reels and building out the news feed, I think it'd be trading so much higher.
Yeah, I think if there's a pivot, right, there's going to be a big rally. If there's a TikTok ban, there's going to be a big rally. But I don't see why he's going to pivot unless unless he starts to see that he's losing employees, right? A lot of these technology companies have structured their relationships with employees almost contingent on their stock price rising into perpetuity, whether it's aggressive equity and or option packages. So if I'm an engineer at Facebook, and look, I don't know the darndest thing about technology. I am a dunce when it comes to technology. I know a lot of the folks who are in the Wook server, a lot of our Wookiees are interested in technology. I've historically personally shied away from investing in tech, and obviously missed out on some incredible returns up until this year, perhaps in tech. But you think about those employees who maybe came on when they got stock options at 200, 300, 400, whatever. Those options are worthless. What are their shares worth? What's the vesting look like there? Will he begin seeing turnover because of the stock price? Right. I mean, that's a reality that these employees, they may not be all aboard the metaverse vision that Mark Zuckerberg has. They may have been like, hey, I really like getting to work on this. That's cool and all, but clearly, Mark, the capital markets are saying something else to you, and you're ignoring them. So there's a lot of risks right now the company faces beyond just the share price going down. It becomes a little bit of a self-fulfilling prophecy, right? The price keeps going down and down and down. It does become harder to attract and retain top-tier talent, and that's a big expense, right? Getting the engineers beyond just the data centers and the hardware, cost of goods sold. I know that they rolled out the $1,500 headset that's whenever it's going to come out. And to your point, Joe, the economy is a little bit different. In 2022, somebody might have been willing to drop a stimmy on a $1,500 VR AR headset in 2021 when all their YOLOs kept paying off. But perhaps they've run out of cash and maybe they're not going to put it on a credit card or on a on a payment plan now.
Yeah, exactly. I think people are less enthusiastic, especially with the association people place between crypto and the metaverse, and people see it like kind of intertwined in like one vision of the future. And as crypto's fallen as much as it has, there's less faith in the metaverse. There's just like that association between the two.
Right. And when you ask people like, what is the metaverse, you get such disparate answers. And it's like, well, you could argue like we're already in a metaverse. We're engaging, you and I have talked about it. We had never met in person. We still haven't met in person. Obviously, we've now talked over a video camera, but like we had a purely digital relationship for a long time. Is that the metaverse? What does it mean to be part of the metaverse? Do you have to have some sort of a hardware piece? I know Apple's view is more about augmented reality as opposed to like metaverse. I'm doing air quotes with my fingers for those of you not watching the video stream. So, Mark is definitely bold. He's obviously historically been rewarded for his boldness, but this is definitely the biggest challenge yet. And the share price dropping into the double digits, it just gives him more headwinds, and he's got to try to keep those engineers and make sure they don't get so discouraged by the share price that they decide to jump ship to Elon Musk's Twitter and work on code there. But yeah, it remains to be seen. It certainly, again, the altimeter letter says, by cutting staff at least 20%, reducing capex by at least 5 to 25 billion annually, and capping yearly investment in the metaverse at least 5 billion, as opposed to the current 10 billion. Annual free cash flow could be quadrupled to 40 billion, which compares with a market cap right now, today at the close, of 266 billion. So if he took their advice and they generated 40 billion in free cash flow, that's a 15% free cash flow yield, at least on the market cap. Offhand, I don't remember. I don't think Facebook has much debt. I think they have a net cash position. So the enterprise, the EV yield is pretty comparable, I think. Correct me if I'm wrong, but that's a damn attractive cash generating business if Mark followed their advice and did that. But clearly, Mark's saying, I'm looking super long term. I think super long term, metaverse is the play. So it will be very interesting to continue to watch it play out. I do simply think that so many investors have been burned and are being burned that, does he reach a point that he is forced by capital markets to maybe put his foot on the brake pad, or at least take his foot off the accelerator and stop incinerating, or at least in the view of markets, incinerating so much on this metaverse? If you burn money in the metaverse, did it really get destroyed? Okay, coming
I think.
yeah,
Sorry, just one thing I want to say. The game. When you say like, what is the metaverse, and like, are we already in the metaverse? Like, that's just how I felt when it comes to, especially if you were a gamer. If you spend a lot of time gaming, like I used to, and that's my vision of it. You're hopping online, you're putting a headset on, you're talking to your friends and in a party chat, and like you're all playing these games together, all in these virtual worlds.
we're going
Like
on a raid, buddy.
that's the metaverse. Like I don't know. You look at what Zuckerberg puts out, and you look at the graphics and the attention to detail. I mean, it's nothing in comparison to what like Rockstar can put out. So that's where I stand. I think if you're looking at like the metaverse from like a social media angle, you're like missing it.
Yeah, exactly. The social piece is there. What is the differentiator for this metaverse that Mark envisions? I don't know. But I put an image up on screen that not Mark, that John Authors had put in his points of return. Again, a fantastic newsletter. Really, I think it's a must follow. He sends it out late at night, East Coast time, on a daily basis. But in his points of return, one of them this week, he had a chart from the terminal that had Meta versus S&P, as well as S&P total return with dividends reinvested, and Meta is now lagging the S&P 500 even without dividends since the 2012 IPO, which is just pretty incredible. When you think back to just a year ago, it was so high flying. So it's a fallen angel. You have to go through this like period of investor base turning over that I was kind of talking about. So it'll be like GameStop, right? Like many of these stocks who have very disparate opinions about them. Always fun to follow where they go into the future. If we had our crystal ball, we would be widely. I probably wouldn't be hosting this program right now, but I finished my beer, which was delicious. It's 5:26. If anyone wants to chime in and add any thoughts or questions, would love to field them and listen to them. Otherwise, I'm going to plan on wrapping this in the next 10-15 minutes. So just one last thought I'll kind of add. I didn't necessarily talk about it this week, but I've seen it discussed in a few places, this idea that, and it's not just my thought, others have talked about it, but this idea that, value and asset heavy companies that might be cheaper on a traditional, relative to book value, relative to their near dated cash flow generating capability basis, may outperform. On my screen, I just have the year to date performance of the major indices. And you can really see in the last month that the Dow Jones, the 30 stocks that comprise the Dow Jones, has outpaced year to date. It's almost 10% better than the S&P, which S&P is 11% better than NASDAQ. So, you see a big spread between the Dow and the NASDAQ, a 20% year-to-date delta. So if you'd been all in a Dow Jones index, those 30 big stocks that are less technology oriented, you would be, down less than 10% year to date. You'd be down 9.5%. Whereas if you were all in, the NASDAQ 100, you're still down almost 30% year to date. I believe we're in more of a regime like the .com bust, where it's NASDAQ still doesn't look cheap. Technology still doesn't look cheap. Barring a return to zero interest rate policy, I still think there's a lot more downside in the NASDAQ. And so far markets have kind of been playing out that, but it's really gotten more stark in the last month or so. If you're looking at my screen, you can really see the delta between the orange line of the Dow and the purple line of the NASDAQ kind of widening out. So I think that trend continues. But just another thought before we wrap. Again, if anybody had wanted to add any comments or ask any questions, last call. Joe, is there anything else you had in mind?
No, I'd say that just about sums it up. We're at about an hour 30. You've got a dinner reservation to make, I believe, with your parents.
Yep.
If anyone has anything, though, feel free to raise your hand. We'll have some announcements coming in about the book club as we determine which book, and that'll be meeting next month. So thanks, everyone. Thanks for tuning in. I'll let Rod leave you with some closing remarks. He's throwing up some emojis I see on the screen now.
Always fun to play with emojis and emotes in Discord. But yes, thank you very much for tuning into this 6th edition of the Wook Review. To let folks know what we have planned, I mentioned the book club earlier. Again, we're going to be distributing shortly what the actual next reading is, with the plan to, in the first week of December, host our next book club. Thank you to those who participated in our Richer, Wiser, Happier broadcast. I think it was an excellent conversation. It was fun. I enjoyed it, even though it kept me from gambling. Just kidding. I had a great week in Vegas, including my time talking with my Wookiees. But also next week on Wednesday night Eastern, I haven't yet settled on 7 or 8 p.m. If anyone has any serious preference, please let me know. But we're going to begin hosting an additional weekly program. I'm going to host this under my personal account as opposed to the Wook handle. Obviously, I'll read my disclaimer, but this kind of thing is, let's just talk about different topics that come to people's mind. Joe, myself, and Han on our team will kind of have at least one topic we're interested in talking about. And we're going to do these on Wednesday evening. Obviously, I understand some people on a Friday at the close, A, they might still be working, and B, they might say, I'm done with this week, I don't want to tune in. So Wednesday nights, we're going to start to have a weekly discussion. It'll be less structured than this one, which is already kind of open. But we'll have an open discussion around whatever topics people want to talk about. I'll be hosting it under my @RodAlsman handle on Twitter. There won't be a commensurate video presentation, so it's just audio only. We'll just bullshit for an hour or two on Wednesday nights. Again, it'll be either 7 p.m. Eastern or 8 p.m. Eastern. You'll hear more about that in short order. So thank you, everybody, for tuning in today and checking out our Wook Review. We certainly welcome any feedback that you may have on different types of content that we should be producing that help add value and help to make all of us more informed and aware of what's going on in the world and in financial markets. So thank you, everybody. I hope you have a great weekend. Stay safe out there. And good night. Cheers.